There is a subtle but important shift that begins to occur once an individual crosses into seven-figure territory, and it is not immediately visible in lifestyle, spending patterns, or even outward investment behavior, but rather in how decisions are filtered, evaluated, and ultimately executed within the broader financial system they operate in. At earlier stages, financial decisions tend to be driven by necessity and momentum, where the primary objective is to create upward movement, to expand the base, and to convert limited resources into something that compounds over time, which naturally encourages a bias toward action, toward participation, and toward seizing available opportunities even when uncertainty is present. But once capital reaches a certain threshold, the nature of decision-making begins to change, not because the individual suddenly becomes more intelligent or more informed, but because the system they're operating within has fundamentally evolved. And that evolution introduces new constraints, new risks, and new forms of leverage that were previously irrelevant. One of the first noticeable changes is how time is perceived. At lower levels of capital, time often feels scarce, which creates urgency, a sense that opportunities must be acted upon quickly, that delays carry a cost, and that inactivity is equivalent to falling behind. But as capital grows, time begins to expand, not literally, but functionally, because the system itself generates momentum, and this reduces the pressure to act immediately. This shift in perceived time changes behavior in a meaningful way. Decisions are no longer evaluated based solely on potential return, but also on timing, alignment, and structural fit within the broader system, which means that not every opportunity needs to be pursued, and more importantly, not every opportunity deserves attention. Another layer of this shift involves how risk is interpreted. At smaller scales, risk is often simplified into volatility, the visible fluctuations in value that occur over short periods. But at higher levels, risk becomes multidimensional, incorporating elements such as liquidity constraints, concentration exposure, systemic correlation, and the potential for forced decisions under unfavorable conditions. This expanded definition of risk leads to a more selective approach to deployment, where preserving the ability to act becomes just as important as the act itself, and this is where the concept of optionality starts to take a central role. Optionality, in this context, is not about predicting the future with precision, but about maintaining flexibility within the system, ensuring that capital is positioned in a way that allows for adaptation as conditions evolve, which often requires holding a portion of resources in forms that do not immediately generate returns. From the outside, this behavior can appear inefficient. Idle capital is often interpreted as missed opportunity, as unproductive space within the system, but internally, it serves a different function, acting as a buffer against uncertainty and as a reserve that can be deployed when conditions align more favorably. This introduces a distinction between visible productivity and structural efficiency. Not all productive actions are efficient in the long term, and not all inactive positions are inefficient when viewed within the context of a larger system. As capital scales, this distinction becomes increasingly important. Another aspect of this psychological shift is how opportunities themselves are evaluated. At earlier stages, the range of accessible opportunities is relatively uniform, dominated by public markets, widely available assets, and standardized strategies, which creates a framework where consistency and participation tend to yield results over time. However, as capital increases, the landscape of opportunities becomes more varied and less continuous. Certain opportunities emerge only under specific conditions, during particular phases of economic cycles, or within networks that require both capital and timing to access. This means that being fully invested at all times can actually reduce the ability to engage with these higher quality opportunities when they appear. And this is where patience begins to transform from a passive trait into an active component of strategy. Patience, at this level, is not about waiting without direction, but about maintaining readiness, preserving flexibility, and allowing conditions to develop before committing resources, which often leads to fewer decisions, but more impactful ones. There is also a shift in how success is measured. At smaller scales, Success is often tied to growth rates, percentage returns, and the speed at which capital expands, but as the system grows, the definition of success broadens to include stability, resilience, and the ability to sustain performance across varying conditions. This broader definition naturally influences behavior. Decisions are made not only based on potential upside, but also on how they affect the system's ability to endure downside scenarios, which often leads to more conservative positioning, even if it results in slightly lower returns in the short term. Another layer of this transformation involves the relationship between control and exposure. Deploying capital increases exposure to potential gains, but it also reduces control over how that capital can be adjusted, reallocated, or withdrawn, particularly in environments where liquidity is limited or where exit conditions are uncertain. Maintaining a portion of capital in liquid or flexible forms preserves control, even if it limits immediate exposure, and balancing these two forces becomes a central aspect of decision-making at higher levels of wealth. There is also a behavioral component that becomes more pronounced. At earlier stages, activity is often associated with progress. Taking action, making investments, and engaging with opportunities creates a sense of movement, which reinforces the idea that doing more leads to better outcomes, but as capital grows, this relationship begins to weaken. More activity does not necessarily produce better results, and in some cases, it can introduce unnecessary complexity, increase exposure to risk, and reduce the system's ability to adapt. This leads to a different kind of discipline. Instead of focusing on doing more, the focus shifts toward doing less, but doing it with greater precision, greater alignment, and greater awareness of how each decision fits within the overall system. This discipline is not always visible, and it often contrasts with widely accepted financial advice that emphasizes consistency, regular contributions, and long-term participation, which remain effective at certain scales, but do not fully capture the dynamics that emerge as capital grows. From a systems perspective, what is happening is a reconfiguration of roles within the financial structure. Capital is no longer treated as a single resource with a singular purpose. It becomes segmented, with different portions serving different functions, some focused on growth, others on protection, and others on maintaining flexibility. This segmentation allows the system to operate more efficiently across different conditions, but it also requires a more nuanced approach to decision-making. There is also an interaction between scale and constraints. As capital increases, the ability to move freely within markets can become limited. Large allocations can influence pricing, reduce liquidity, and create execution challenges that do not exist at smaller scales, which means that selectivity is not just a preference, but a necessity. Holding capital, in this context, becomes a way to manage these constraints, ensuring that actions can be taken without disrupting the system itself. Another important dimension is how uncertainty is approached. At earlier stages, uncertainty is often something to be minimized through diversification and consistent participation, but at higher levels, uncertainty becomes something that can be partially leveraged, not by predicting it, but by maintaining the ability to respond to it. Liquidity becomes a tool for engaging with uncertainty, allowing the system to adapt as new information emerges, rather than being locked into positions that cannot be easily adjusted. There is also a temporal aspect that becomes more significant. Capital deployment is no longer just about where resources are allocated, but also when they are allocated, and this sequencing can have a meaningful impact on outcomes. Deploying capital at different points in a cycle can produce significantly different results, even if the underlying assets are similar, which introduces a layer of timing that is often underappreciated in simpler frameworks. Maintaining flexibility through reserved capital allows for better alignment with these temporal dynamics. As all of these layers begin to interact, a broader pattern emerges. The system becomes less about maximizing activity and more about optimizing alignment, ensuring that decisions are made in a way that supports long-term stability, adaptability, and sustained growth. And within this framework, the decision to not act becomes just as important as the decision to act. Inactivity, when it is intentional and aligned with the system's structure, is not a lack of strategy, but a form of strategy in itself. It preserves options, reduces unnecessary exposure, and maintains the capacity to respond when conditions are more favorable. This is the core of the psychological shift that occurs at higher levels of wealth. It is not defined by what is done, but by how decisions are filtered, how risks are interpreted, and how capital is positioned within a system that must operate across varying conditions and timeframes. And as this perspective develops, the relationship between action and outcome begins to change. Success is no longer driven by constant participation, but by selective engagement, where fewer decisions, made with greater alignment, can shape outcomes more effectively than continuous activity. In this sense, the shift is not about doing more with money. It is about understanding when to do less and why that restraint, within the context of a larger system, can produce more stable and coherent results over time. And when this shift is examined more closely, another layer begins to surface, which is how decision-making itself becomes increasingly filtered through systems rather than impulses, because at higher levels of capital, individual decisions are rarely isolated. They are interconnected, influencing liquidity, exposure, timing, and future optionality all at once, which creates a need for coherence across the entire structure rather than optimization at a single point. This introduces a form of internal alignment that was not required at earlier stages. Decisions are no longer judged purely on whether they are good or bad in isolation, but on whether they fit within the broader architecture of the system, whether they enhance flexibility, preserve resilience, and maintain the ability to respond to future conditions that cannot yet be fully defined. And this is where the idea of strategic restraint becomes more refined. It is not simply about holding back capital, but about understanding the cost of misalignment, recognizing that deploying capital at the wrong time, in the wrong structure, or under the wrong conditions can create constraints that persist far longer than the initial decision itself. There is also an increasing awareness of asymmetry. At smaller scales, outcomes tend to be more linear, where effort and activity produce relatively proportional results, but at larger scales, outcomes often become nonlinear, shaped by a smaller number of high-impact decisions that carry disproportionate influence over the system. This naturally shifts attention away from constant engagement and toward identifying moments where the structure, timing, and conditions align in a way that allows capital to operate more efficiently. In between those moments, inactivity is not wasted space. It is the state that preserves the ability to recognize and act on those asymmetries when they appear. Another subtle transformation occurs in how feedback is interpreted. Short-term results become less dominant as signals because they may not fully reflect the quality of underlying decisions, especially in systems where outcomes unfold over longer time horizons. This reduces the tendency to react to immediate fluctuations and reinforces a more stable, process-oriented approach to decision-making, where consistency is derived from alignment rather than repetition. There is also a growing separation between visibility and effectiveness. Actions that are highly visible, such as frequent trades or constant reallocations, may create the appearance of control and activity, but they do not necessarily contribute to long-term system efficiency. Conversely, less visible behaviors, such as holding liquidity, waiting for structural clarity, or declining marginal opportunities, may appear passive, yet play a significant role in preserving the system's integrity over time. As this perspective continues to develop, the role of capital becomes increasingly abstract. It is no longer just a medium for generating returns, but a tool for navigating complexity, managing uncertainty, and aligning with opportunities that exist within evolving economic structures. And within this framework, the distinction between action and inaction becomes less rigid. They are not opposing forces, but complementary mechanisms, each serving a purpose depending on the state of the system. Ultimately, what defines this stage is not the accumulation of more capital, but the refinement of how that capital is understood, positioned, and deployed within a system that operates beyond simple cause-and-effect relationships. And it is within this refinement that the psychological shift becomes fully realized, not as a visible change in behavior, but as a deeper structural awareness that shapes decisions quietly, consistently, and over extended periods of time.